Hi, we're so happy to be with you today. I'm Carla Cottrell. I'm a realtor with eXp Realty. I specialize in residential real estate here in Volusia County, but also I am along the coast of East Florida. I go from about Ponte Vedra Beach down to Melbourne. I really enjoy this area of the state. I'm from here, and my husband is from this area, so we know it well. I'm a native Floridian and a sixth-generation Floridian. So I know the market, but sometimes I need help, and that's where my mortgage partners come in. So today we have with us Tippi Schalkham, and she's going to talk to you about herself a little bit and how she got in the mortgage business. She's going to talk about her company, what types of loans she has, and just some other things that might help you get comfortable with the mortgage process. So Tippi, welcome.
Hi, thanks for having me, Carla.
So glad you could make the time.
Thank you so much.
Tell us about you.
Okay, so my name is Tippi Schalkham. I work with certified mortgage planners. I got into this business a few years ago when I moved to New Smyrna Beach. Previously, I have a finance degree from West Virginia University. I grew up in West Virginia. I did commercial lending when I got out of college for a while, and then I took a few years to stay home with my children, and then after that I decided to get into residential.
Awesome. And Tippi's a great partner for me because she's very communicative, so I never have to guess where we are in the process. And for a lot of home buyers, you may have done it before, but maybe it was 20 years ago, or maybe it was 30 years ago, and the process is completely changed now. Yeah, so it really helps for me and for my customers to have a mortgage lender that will communicate and stay on top of every detail so that there's no question whether the deal's going to get done and nobody has to get their nerves riled up over it. So tell us a little bit about certified mortgage planners and what types of programs are available.
Okay, so certified mortgage planners, I really love this company. One of the big things that I like about them is that they don't just try to pre-approve you and stick you in a loan. We take the time to review your short-term and your long-term financial goals. Where do you really want your payment to be? How long are you going to stay in the house? It all determines the best product for you. So it's not like one thing fits everybody.
Okay.
So that's what I like. We definitely offer all the traditional lending. We have FHA, VA, USDA, and then conventional loans. And then we also have a long list of like non-traditional loans that fit kind of niche little products.
Yeah. So. Okay. Wonderful. Well, for today's purposes, because that would be a lot to go over in one segment, let's talk mostly about conventional lending. When do we know if a conventional loan would be the way to go?
A conventional loan in general is not backed by a government agency, so it has to meet the criteria of Fannie Mae and Freddie Mac. Okay. I would say that if a borrower has got decent credit, a down payment, and has a debt to income ratio that is less than 50%, they're going to fit into that conventional lending type of product.
And what are the advantages of conventional lending over another kind of loan?
The rates are going to be much better. The mortgage insurance is another huge one with conventional lending. When you get to 20% equity in your home, that goes away. So if you don't put 20% down, you know that at some point that's going to disappear for you and your payment's going to be lower. If you get an FHA type of loan, it sticks for the life of the loan. So.
Right. Okay. Well, that's good to know. I know a lot of people have great assets, but they've got their wealth spread around different places. So sometimes that's a scramble to get the down payment together and stuff.
Absolutely.
But if they can, then it pays off. They don't have to pay that insurance.
Absolutely.
Yeah.
Absolutely. Awesome. And there is a conventional home ready program that's available for first-time home buyers. And it's 3% down. So
wow.
Even a lot of cases, that's even better than an FHA type of situation. Again, you have the mortgage insurance, but it definitely is a niche type of thing for someone who's got, great credit and maybe just buying their first home. They can, you can qualify and save some money for furniture or fixing something up or whatever they need to do. So
yeah, that's awesome to know about.
Yeah.
Wow. So I know a lot of people talk about, well, should I get a 15-year loan, or should I get a 30-year loan, or should I get a ARM, or should I get this? What can you tell us about that?
Okay, so I would say we get those questions a lot, and I definitely usually run both scenarios for people to let them kind of feel out what they want to do. It determines your interest rate, whether or not you do 15 or 30. 30 is probably what most people get. 30, you're going to have a lower payment, but you're going to pay interest for a longer period of time. On a 15-year, you're going to have a better interest rate and you're going to pay less interest, but your payment is going to be almost double. So for people that want to keep their payment low, first-time home buyers, a lot of the times they're going to want to stick with a 30-year, just so that that payment is something that they can easily handle every month.
Well, one of the things that I know that we go over with new buyers a lot is, you know, if you make one extra payment a year, it really helps you out. Talk about that.
I was actually looking into that the other day for somebody. $200 a month extra takes about 8 years off of your mortgage.
Wow.
So a lot of times if people are on the fence, I'll say just do the 30. And you know, that way if you do get into a tough time, or in this economy right now, the way the world is, you don't feel comfortable or something comes up, you can just make a payment that you feel comfortable with, and then, you know, throw a chunk at it every now and then.
Yeah, that's awesome. I know I had one scenario where a buyer said, every time my tax return comes back, I pay that money into my mortgage.
Absolutely.
And she actually managed to take about 6 years off her mortgage just doing that.
It makes a big difference. And I actually had friends recently that just refinanced into a 15, and now they're actually wanting to go back to the 30 because they miss that freedom of being able to have that extra, you know, hands-on money each month.
Freedom's good.
So yes, exactly.
Especially financial freedom.
Yes.
So talk a little bit about how down payment is determined.
Down payment's determined by a lot of different things. 5% would be the minimum. I would say it depends on if you're getting a gift. Some people, you know, use gifts for their down payment. Sometimes you have to put more down to qualify. Some people's ratios, I have to tell them you have to put 10% down in order to buy this specific home. So there is a lot of things that go into that. And the more you put down, sometimes your interest rate might be better. And if they're interest rate people that really want that best rate, then they might want to really put the extra money down and get that rate over the period of time. So,
sure.
Yeah.
Okay. Well, so when you first, when someone comes to me, the first question I ask them is, do you have a pre-approval letter?
Yes.
Because that really will determine when we're actually ready to shop for a home. You don't really know if you're ready to shop for a home until you know how much you can afford to pay for a home. You might have your eye on that $450,000 home, but your pre-approval comes back at $300,000. So we don't want to break your heart by showing you that property that you can't afford.
Exactly.
We want to show you what you can afford and make that the goal. So talk about the pre-approval process and how that works.
Exactly. Okay, so when someone first comes to me, I like to sit down and talk to them about, like I said, their long-term, short-term goals. That's kind of the first thing I do. And then we definitely want to talk about employment. That's the big thing. So how are you paid? Are you self-employed? Are you hourly, salary? Do you get commission, bonuses, and all that kind of thing? So documentation is huge. The quicker that people can get documents to us so that we can review those things, the better. So first of all, I would talk to them about that. I would pull their credit, of course, to see kind of where that sits. And then I would look at that with their documents and see what their ratios look like and where I can kind of fit them.
Okay.
So
awesome. And then most times I know I've been able to get a pre-approval from Tippi within like a few hours.
Yeah, if the customer works with us and they can get us everything that we need, we can do that super quick. That's not a hard thing to get done. And they're usually good for about 90 days. So that's how long the credit report stays, effective. So after 90 days, we would reevaluate, pull a new credit report, update documents as long as nothing has changed, and then we just issue another letter.
Right. In this market, though, I can tell you, people who get pre-approved don't wait the whole 90 days to buy a home.
No, you don't want to wait the whole 90 days.
You don't want to wait. So talk about, what are loan origination fees? And can they go up or down depending? I mean, what do they depend on?
For our company, we break ours up into a processing fee and an administrative fee. So for our company, it's $14.95 total for both. So it's $7.95 and then $700.
Nice.
So those generally stay the same no matter what. FHA might have a little cheaper on those initial fees, but generally those stay the same. But like I said, if you want to talk to a loan officer, sometimes they have programs for healthcare professionals, heroes, teachers, police officers, anything like that, and they will sometimes give a deal on waiving some of those.
Yeah, recently I had a nurse who she needed good news this year because she's been really inundated with COVID patients, and she got a great deal with her origination fees because she's a nurse and she was working in that kind of situation.
Yes, it's definitely worth asking. Right now, especially in these days, there's a lot of heroes out there. So
absolutely.
Yeah.
So now, what about, are there other fees that people need to be aware of when they look at the closing statement? Sometimes they're like, what is all this stuff? Yeah.
The appraisal and survey are the first two things I would say you'll definitely have to pay for. Appraisal is the only out-of-pocket expense that you'll have, and your inspection fees if you choose to do inspections that we would charge up front. Anything else is going to come at the end when you close. Title fees are a big one. Let's see. Doc stamps,
deed stamps,
all that stuff is based on the loan amount.
Right.
So it's nothing that your loan officer is coming up with. It's standard. We use title company.
A state formula.
It is. It's through the state. So all of those are normal fees. And then another thing that I try to talk to borrowers about is escrow. That's a huge one. A lot of people don't understand. It can be a lot. It can be a little. It depends on what time of year you close, when your taxes and your insurance are due. So those can change and make closing costs look a lot inflated when they're truly going into an account for you, so that when the time comes, it's there to pay.
It's there, yeah.
Yeah.
So, that was a question some of my folks have. They say things like, well, can I just pay my insurance premium up front? Why do I have to escrow that? Or can I pay my taxes up front? Or when the tax bill comes due, do I have to escrow those things?
You do not have to escrow, but there is a charge. It's a 0.25%. To not waive to waive your escrows in a sense. So that way you pay them on your own and you don't have to put them as part of your mortgage payment.
Okay.
But
so if you're making more money in the market or something, and that's how you're going to pay your taxes and insurance, then 1/4 point may not be a big deal.
Some people don't care, but then there's some people that just don't like fees in general.
Right.
And they don't want to pay any extra fee that they have to pay.
I'm not a fan of fees myself.
No. So, so I would say most people do escrow.
Yeah.
But it's definitely an option.
Yeah. Okay. Great. So now I said 1/4 point. Explain points. That seems to be a huge question that people have.
So points. So 1 point is 1% of your loan amount. So that's kind of how we figure how much those are going to be. It's kind of one of those things you got to talk to your loan officer about. It's to buy down your rate. So you got to see how long you're going to be in the house to see if it's worth it for you. If and your loan officer can do some simple math and kind of come up with your break-even point, saying, Carla, if you were going to stay there for 3 years, you're going to make that money back that you paid for that point.
Sure.
So if it's worth it for you or not. If you're going to move in a year and sell, it's probably not worth it.
Yeah. Okay.
Yeah.
I got to tell you, you're making this really easy.
Well, that's good.
See, this is why Tippi is a good one to use, because it sounds so simple when she says it. So tell us about interest rates and how those are determined.
Interest rate, that's determined by a lot of things. Credit is the big one, credit score, credit history. How long have you had credit and been using credit? Have you been using your credit the right way? It looks at all of that. Also down payment, the more you put down. There's just... Well,
and the Fed, you have a basic rate,
well,
right?
The Fed sends the rates out, but as far as what your rate would be, everybody's got a different rate. So when people ask me, what's the rate right now, I could tell them, generally speaking, this is where it is. Yeah. But it's hard to really pinpoint that without looking at someone's credit and all that good stuff.
So I know rates fluctuate a little bit, but lately it seems like they've gone just a little up and a little down and a little up. And it's not been like a huge swing.
No, they're just kind of...
So, but I hear people saying things like, but I want to lock in this rate. What does it mean to lock in?
So once you're under contract, you can lock your rate. So that means that we will go in and we can lock it for 30, 45, or 60 days, depending on when your closing date is.
Okay.
So obviously a 30-day lock is you're going to have a little bit of better rate than a 60-day lock, because you're taking more time there. So, but locking in means that it's not going to fluctuate. That's it. No matter what happens in the next 60 days or whatever it is, you're good. As long as nothing changed with your application,
right?
You're good to go.
Like you've quit your job. Don't do that. Don't do that.
Yeah, don't do that.
Okay, so another thing that people have questions about all the time is loan servicing and what it means when your mortgage is sold.
Yeah. So the first thing, most loans are sold. So, and most of them are sold right after closing.
Yeah.
Before you even make your first payment, they're usually sold to someone that's going to service it. And a servicer is someone that's going to take care of the day-to-day part of your loan. So you're gonna call them for your customer service. You're gonna call them if you've got escrow questions. You're gonna call them if you have a question about your bill. They're taking care of just that customer service aspect. And some loans can be sold several times. So, and it's not a big deal to have your loan sold. It's very, like I said, it's a very normal thing. And nothing in your loan changes. So that's kind of the key thing. You're not, your rate stays the same, your payment stays the same. They're just changing who's going to take care of it for you.
So I guess one of the things that makes people nervous, though, is because there's fraud out there, right? There's all kinds of fraud.
Yeah.
And it seems like people come up with new ways to defraud people every day.
Yeah.
So how does someone know? How does someone believe? Well, you get a letter in the mail saying this company is now servicing your loan. How do you know it's safe to send them a payment?
I would call. I still say you should call. I would call your previous servicer.
Yeah.
And ask them, have you sold my loan?
Okay.
Is this correct? Is this the new person that I'm going to send my payment to?
Right.
So I still
verify. Trust but verify,
verify
right?
everything, and I would say if it's right after you've closed, it's probably true, but it's always good to call and check and make sure that you've got that information correct before you send a payment.
All right, so we've talked about a lot of things today, and I know that it's gone pretty quickly. We're doing that so that we don't overwhelm people. But we're going to put a banner in to show you how to get in touch with Tippi or with me if you have any questions or you just want to chat about something you heard today. We encourage you to comment and ask questions so we can get better at this over time, and we can cover all the issues that are at hand. Tippi, is there anything you think you'd like to add?
So in general, I would say that in order to make things such a smooth process, it's up to the borrower to supply all the things that we need, and just know that your loan officer isn't just asking for things just to get your information. We have to supply what we're asking for in order to make it happen for you. So
yeah, absolutely. Which is a reason to pick somebody you trust.
Absolutely.
Somebody that's got a good reputation, that your realtor trusts.
Yeah.
Generally speaking, realtors work with 3 or 4 different lenders, and we can tell you the ones that we prefer. And there are reasons for that because of past experiences. So I would say, if you trust your realtor, listen to your realtor. If you're completely blind about the whole thing, call Tippi, call me. We'll walk you through it, and we'll make it a great experience.
Absolutely.
And thanks for tuning in today.
Thank you.